welcome to the World Battery Metals and Mining News for the 27th of August, 2024. First Quantum seeks damages for copper trapped at Panama mine. First Quantum Minerals is embroiled in a heated arbitration with Panama over a stockpile of semi-processed copper ore worth between $225 million and $340 million that has been stranded since the government shut down the Cobre Panama mine amid public protests. The company is scrambling for compensation, arguing that leaving the 120,000 metric tons of material to languish poses environmental risks and financial losses. On top of two active arbitration cases seeking a whopping $20 billion, First Quantum asserts Panama should either let them ship the copper or cough up its market value. Let's just say the snail-paced bureaucratic tango is really straining First Quantum's patience and wallet. The dispute is caught in a protracted legal quagmire, with a key hearing not slated until September 2025. Meanwhile, other heavyweights like Franco-Nevada and Liebherr are also pursuing claims related to the mine's closure. Panama's response? Crickets. Industry warns sovereign risk in Australia is rising. BHP's resistance to the Australian government's slump, same job, same pay legislation underscores its concern that paying inexperienced labor at par with seasoned workers will inflate costs and erode productivity. BHP CEO Mike Henry emphasized the new regulation's potential to hike labor costs without enhancing productivity, potentially stifling future iron ore expansions. This regulatory frustration echoes in the industry's broader outcry, amplified by Environment Minister Tanya Plibersek's veto of the Regis Resources McPhillamys Gold Project, despite it clearing significant state and federal approvals. The shock decision, compounded by impending federal environmental law reforms introducing a national EPA, has rattled the mining sector, sparking fears of doubled regulation and increased project costs. Industry leaders, like Northern Star and Whitehaven Coal, warn that such shifts threaten Australia's investment allure, as regulatory unpredictability weighs heavily on the sector's competitive edge. The chorus of discontent from various mining executives highlights an urgent call for more certainty to safeguard Australia's historically high investment appeal. Goldman Sachs analysis sheds light on rise of commodities in ESG. Well, it seems like the ESG world is finally broadening its horizons beyond the typical left-wing commoditophobic agenda. A recent Goldman Sachs analysis reveals that fund managers are now incorporating more oil, gas, and mining stocks into portfolios that are still tagged as ESG compliant. The European Union's Sustainable Finance Disclosure Regulation, SFDR, might be revising its strict stance, allowing for investments in industries that, while not exactly green today, might have an eco-friendly future. Interestingly, the number of Article 8 funds, the less restrictive category, holding at least one oil and gas company rose from 47% to 51% over the past year. As for mining, 46% of Article 8 funds and 32% of the stricter Article 9 funds now hold at least one such stock, a notable increase compared to last year. This shift probably owes much to the newfound realistic take on what it means to transition to a greener economy, acknowledging that we can't just wish away fundamental industries. Even as these funds generally remain underweight in commodities, the trend is clearly shifting towards more inclusive definitions of sustainability. Still, recent net outflows and the ongoing revamp of SFDR guidelines suggest that while the ESG craze may be tapering off in equities, it's booming in bonds. Might this be a sign of more balanced, rational thinking in the future of sustainable investing? One can only hope. BHP sees copper surplus in short term before fly-up prices. BHP Group Limited, the world's second-largest copper supplier, has revised its stance on the near-term copper market, projecting a modest global surplus until 2025 due to a slowdown in Chinese demand influenced by an economic dip and property crisis. Despite this, BHP remains bullish on copper's long-term prospects, predicting significant price surges driven by future shortages aligned with the energy transition, data centers, and expansive power grids. The miner forecasts volatility in commodity markets, but underscores the inevitability of a fly-up pricing regime later this decade due to sustained high demand and insufficient supply. while copper prices rose slightly to 9,373.5 a ton on the London Metal Exchange. They remain significantly lower than the record highs of mid-May, a telltale sign of current market uncertainties and BHP's cautious optimism. Battery metals slump slashes average EV materials bill. Despite the hyperventilation over an apparent slowdown in the electric vehicle EV market outside China, sales are still on track to exceed 20 million units this year. More importantly, the battery capacity deployed, the true gauge for demand in our line of business, surged by 23% in the first half of the year, hitting a whopping 365.5 gigawatt hours. Surprisingly, the shift towards hybrids, which use smaller batteries, hasn't derailed this growth. However, the declining prices of essential battery metals paint a different picture. According to Adamas Intelligence, the average cost of lithium, nickel, cobalt, manganese, and graphite per EV battery plummeted to $655, down from $1,674 last year. Despite this, metals like nickel have seen price rebounds due to factors like the slow adoption of LFP chemistry outside China and the demand for high nickel cathodes in larger hybrids. This price drop is a boon for automakers aiming to make EVs as affordable as traditional vehicles and could boost consumer interest. Yet, battery metals miners remain spooked by potential prolonged price slumps, although recent monthly upticks offer some reassurance. Clean mining's rational approach will be crucial to navigating these turbulent waters. BYD says fate of lithium project is in hands of Chile government. BYD Co. continues to grapple with uncertainty over its lithium project in Chile as the EV giant negotiates terms with local authorities. Although BYD secured access to preferential lithium carbonate pricing from SQM last April, delayed agreements could push their lithium iron phosphate cathode plant's production beyond the 2025 target. Stella Lee, BYD's executive VP, pointed out that the ball is now in the government's court, highlighting the ongoing negotiations to secure a favorable deal. With lithium prices plummeting to a 3-year low amidst new production surges and a slowed demand for electric vehicles, the stakes are high. Further complicating matters is the looming expiry of SQM's current license in 2030, post which guaranteed preferential pricing remains uncertain. While the project could offer BYD a strategic position within Chile, home to the world's largest lithium reserves, it would also aid Chile in advancing its battery supply chain, a win-win if they can iron out a good deal. Antam plans to acquire smelter owned by Tsingshan unit. Indonesian state-owned enterprise PT Aneka Tambang, Antam, aims to acquire a nickel processing smelter from Tsingshan Holding Group, marking a strategic move towards non-organic growth. This acquisition is intended to bolster Indonesia's downstream mineral processing capabilities and foster the development of an electric vehicle EV battery ecosystem. CEO Nicholas Conter emphasized the significance of this move in a recent presentation, highlighting Antam's commitment to advancing the country's battery production ambitions. In addition to this acquisition, Antam is gearing up to initiate the construction of 2 nickel plants in collaboration with China's Ningbo Contemporary Brump Ligand, CBL, further cementing its role in the burgeoning EV battery sector. Lifezone's Kabanga nickel project gains further U.S. gov't endorsement. Lifezone Metals' Kabanga project in Tanzania just grabbed the U.S. government's attention, particularly from bigwigs in investment initiatives for Africa's critical minerals. Kabanga, one of the world's top undeveloped nickel sulfide deposits, is set to morph into an all-encompassing mine-to-metal operation, producing refined LME-grade nickel, copper, and cobalt. Utilizing Lifezone's innovative hydrometallurgical tech at a refinery in Kahama, they're aiming to ditch the dirty smelting process. In a recent tête-à-tête involving U.S. officials and Kabanga Nickel, talks highlighted the project's role in pushing the energy transition and fostering U.S.-Tanzania economic ties. The U.S. International Development Finance Corporation is even sniffing around for political risk insurance. CEO Chris Showalter touts the U.S. interest as validation of Kabanga's sustainable development goals, echoing Vice President Harris's vision of a project for Tanzanians by Tanzanians. All in all, it's a glimmer of hope for rational, clean mining. Polyus H1 profit jumps on higher global prices. Russia's top gold miner, Polyus, managed to sidestep Western sanctions and post a jaw-dropping 183% surge in first-half profits, making $1.58 billion, driven by soaring global gold prices. With EBITDA also leaping by 20% thanks to a 16% increase in revenue, Polyus has comfortably slapped sanctions in the face. As gold prices touched record highs due to looming U.S. interest rate cuts and Middle East conflicts, Polyus saw its gold output climb by 2% in the first half, pushing it to revise its 2024 production forecast upwards. Despite being blacklisted by the US and the UK over Russia's Ukraine shenanigans, which led to the delisting from the London Stock Exchange, the company is full steam ahead on its Sukhoi log project in eastern Siberia. This project promises to double output by 2027, but has seen its $3.3 billion price tag come under review due to sanctions. Meanwhile, camouflaging these moves, Polyus will temporarily shift processing to the Verninskoye plant, suspending mining there until Sukhoi log is up and running. Polish miner gets renewable reality check in record write-off. Poland's leading coal producer, Lubelski Węgiel Bogdanka SA, has been compelled to devalue its assets by a hefty $305 million as burgeoning wind and solar energy options elbow the so-called dirty fuel out of the market. Despite last year's record profits from high coal prices, the winds of change in the domestic coal sector are undeniable, driven by increased renewable energy capacity. Poland's flirtation with clean power is still in its courtship phase with no concrete energy policy yet, but the trend is clear. Coal's dominance is waning, slipping from over 70% to about 66% of the country's energy mix. This downward spiral will tighten with the advent of offshore wind turbines and gas-fired units, leading up to the country's ambitious plans for a nuclear power plant by the next decade. Bogdanka's response? A strategic reevaluation by the end of 2024, though investors aren't holding their breath, evident from their 27% stock drop this year, while the market showed a modest gain. Vale names CFO Gustavo Pimenta as next CEO. Vale's latest CEO shuffle has finally landed on CFO Gustavo Pimenta, amid a soap opera of boardroom exits and alleged political meddling. Pimenta, who's no stranger to crisis management given his role in negotiating settlements for the 2015 Mariana disaster, will take over from Eduardo Bartolomeo. This drama-filled succession has involved leaks, government interference, and cries of manipulation from board members like José Luciano Duarte Pinedo. Pimenta promises to elevate Vale further, having already focused on capital efficiency and setting emission reduction goals. Though, let's face it, clean mining is more PR than reality. With a robust background in the financial, energy, and mining sectors, Pimenta's experience includes a stint at AES Corp and Citibank, making him well-suited to navigate Vale through these choppy waters and beyond. BHP pumps out record iron ore in FY24 as prices falter. BHP continues to dominate the iron ore sector, hitting record production at its Western Australian operations, despite a significant drop in iron ore prices. With a noteworthy 1% production increase to 255 million tons in the 2024 fiscal year, their profits have seen a modest rise, prompting a hefty dividend payout. As quirky fate would have it, they even managed a revenue bump amidst the price slump. Planned expansions are in the pipeline, potentially pushing production to a whopping 330 million tons annually, assuming market conditions play along. Meanwhile, their Brazilian venture, Samarco, is set to nearly double output with the revival of a second concentrator. Although China's steel production might be stabilizing, BHP is banking on rising scrap-based steelmaking and demand from other developing Asian markets to balance the scales. Copper production is also hustling, increasing by 9% and set for another 4% hike next fiscal year. All this while managing to keep their credit profile robust, as per Moody's, and still addressing operational hazards, reducing high-potential injury frequency by 36%. QEM's Julia Creek project to net billions in revenue. QEM's Julia Creek project in Queensland is poised to generate significant revenue, presenting a post-tax NPV of $1.16 billion and a 16.3% IRR over its 30-year life, primarily from the sale of vanadium pentoxide and transport fuel. While the initial $1.95 billion capex sounds hefty, keep in mind it accounts for all contingencies and indirect costs. The project boasts a 5-year payback period, with expectations of producing around 10,571 tons of high-purity vanadium pentoxide annually, perfect for the surging energy storage market. QEM is exploring multiple funding options, indicating preliminary talks with prominent investment funds and companies, showing their confidence in meeting capital needs. This initiative underscores QEM's ambition to be a key player in the fledgling vanadium flow battery sector, vital for long-duration energy storage. Notably, the recent Australian government classification of vanadium as a critical mineral adds credence to the project's potential, even though the global supply is currently dominated by geopolitical hotspots like China and Russia. Far from a vanity project, Julia Creek represents a robust, multi-commodity resource poised to capitalize on the decarbonization trend, despite my skepticism on the man-made climate change hysteria. And QEM's strategy to tap into multiple revenue streams signals a well-rounded business model. Zijin to miss lithium output target and control pace of projects. Zijin Mining Group's ambitious plunge into the lithium market is hitting a speed bump as the company announces it will miss its production targets for this year, with lithium output failing to reach the anticipated 25,000 tons. Despite boasting a hefty 46% increase in first-half earnings, Zijin is tempering the pace of commissioning its projects amidst an industry awash in oversupply and slumping prices. This powerhouse, well known for its copper and gold ventures, is now diversifying into lithium exploration across China, Argentina, and the Democratic Republic of Congo. Yet, as the lithium market reels from a supply glut and EV demand growth drags its feet, the firm has already slashed next year's target by 20,000 tons to 100,000 tons. With lithium carbonate prices hitting a 3-year nadir, forecasted surpluses are expected to muddy the waters until at least 2027. Perhaps a cautious approach is wise in such a fluctuating market, or maybe it's just another example of the industry's notorious boom and bust cycles. Fortescue beats dividend payout view, shares rise. Fortescue has posted a rise in annual profit driven by increased iron ore shipments from its Iron Bridge project and surprised the market with a larger than anticipated final dividend, sending shares higher. Despite generating its third highest earnings in history, net profit after tax of $5.66 billion fell short of expectations due to higher depreciation and amortization costs. Nonetheless, the company managed to declare a final dividend of $0.89 per share, slightly exceeding analysts' forecasts and maintaining a robust 70% dividend payout ratio. Fortescue's strategic gamble of using high iron ore prices to finance its green energy ventures seems to pay off, notwithstanding market concerns. The board greenlit advancing 2 hydrogen projects in Norway and Brazil to feasibility stages, indicating their commitment to diversifying despite external skepticism.